The economy and asset prices have grown across the world in 2013. For an outlook on what's in store for the year ahead and what is happening with the Federal Reserve, we're joined by economic expert Marcel von Pfyffer from Arminius Capital. Mate, welcome to the program.
Yeah, how are you tonight, Marty? Happy 2014, mate.
Happy 2014 to you as well, my friend. It's great to see you. So, look, we've had a good year in 2013 with economic growth and asset price growth. What is your outlook for 2014, Marcel?
Look, Marty, globally, the economy worldwide will probably grow, we think, around 3.6% or so. This is a little less optimistic than the estimates were, let's say, if we were halfway through 2013, looking at 2014. And the main reason for that really is just that they're expecting a slight pullback in emerging market growth. So, again, middle of 2013, global commentators and global forecasts were expecting emerging markets to grow at about 6% this calendar year, 2014, and that's been wound back to about 4.5%. So the developed nations around the world, those that constitute the G20, those economies probably actually shouldn't grow too much differently to what they grew at last year, 2013, but there will be some slight revision downwards to growth expectations for emerging markets. And again, as our central theme is looking to be for 2014, the reason why the emerging markets growth prospects are going to be marginally lower is, of course, due to what's going to happen in America with the Federal Reserve. Absolutely.
So, tapering, you've got some strong views on what's going on there. What sort of impact are you seeing it's going to have on world markets in the year ahead?
I think Chairman Ben Bernanke's legacy, one of the last things that he will want financial markets globally to dwell upon as he hands the reins of control over to Dr. Janet Yellen is his phrase that tapering is not tightening. Okay, and Dr. Yellen will, of course, be very, very thorough in making sure that markets get the message from her. She's going to be a firm proponent of communicated Federal Reserve policy, and she's going to keep those channels of communication that Bernanke did as well quite emphatically open. So what does that mean? Tapering is not tightening. As we know, the Federal Reserve's QE Infinity program has been wound back by $10 billion as of December 2013. So that's coming back from $85 billion to a mere $75 billion of asset purchases taking place per month by the Federal Reserve. Dr. Yellen, Marty, did her doctorate thesis around employment. Okay, so she is going to be, if anything, even a steadier hand on the tiller when it comes to the repercussions of winding back tapering whilst the unemployment rate in America is above what they are going to target the end of tapering around to about 6.5% unemployment. So again, Dr. Yellen will continue on these alternative methods as opposed to simply interest rates, which again are at the zero bounds. There's not much more they can do there. So,
and that's the difference between tapering and tightening. What you just said there, right? So tapering is obviously exactly right. the reduction in asset purchases, where tightening is actually an increasing of the Fed rate, the Fed funds rate.
Yeah, which again, North is about the only way that they can move. Again, this is why we're in this quandary. That's why we had QE 1, 2 and 3, which is QE Infinity, is that they have exhausted means of normal monetary policy. So they can't actually take interest rates any lower than zero. Yeah. But as I say, and as Bernanke has reiterated the point and will continue to do so until he vacates the post, is that these asset purchases will continue until the unemployment rate hits around 6.5%.
And once it hits 6.5%, they have been pretty clear in saying that the Fed funds rate will stay at, basically zero.
Yeah, that's right.
And it's subject to the health of the economy.
That's exactly right. So unemployment is one of the mandates of the Federal Reserve. Of course, they want to make sure that the economy itself is growing as well. Jobs growth is extremely important, and without it, economic recovery, of course, can't really take place in the US. So the job numbers are of interest, absolutely, from a tapering perspective. But again, Bernanke and Yellen will have and have made the pledge that even when tapering is discontinued, when that policy sees the end of its days, there may be some time yet before tightening takes place. So there is some room in front of us yet.
Excellent. So how do you think Bernanke as a whole has handled the tapering process, and how do you think he'll be judged?
I think history in time will actually look quite favourably upon Ben Bernanke. You could, from one perspective, say that he was handed somewhat of a poisoned chalice. Greenspan exited upon a legacy of wonderful growth in financial markets. Okay, Bernanke wasn't too far into his appointment to the post where he presided over the administration, the bailout of the worst financial crisis to hit the earth since the Great Depression. So Bernanke's track record, of course, the best thing that he did that he will be remembered for is that he was terrified that there would be a repeat of the Japanese type situation where printing money, which was, as we just talked about, the only thing that was left of recourse to them to actually create some semblance of growth in the US economy, is that all of this printing of money would lead to inflation. He was terrified of that, and au contraire, we've actually ended up with something not quite, but very close to zero inflation, or not much inflation at all. And of course, some people actually do argue that there is a case for deflation occurring. But I think the main proponent here that the world will remember Bernanke for is that he presided over saving the US economy by the TARP programs, the TARP packages, and then what he did with what was very, very unorthodox monetary policy implementation, and managed to get away with it all by not creating inflation.
Okay, so let's get on to Yellen. And we had some dialogue over Christmas on the back of an excellent paper that you produced. And you made some comments where you were concerned that the future interest rate projections of a number of the current Federal Reserve Board and presidents was very high, and the speed in which those rates would be increased, you thought, if it actually eventuated, could cause as much damage to world markets as Megatron on a bender. First question, who is Megatron?
That's quite correct. Well, first of all, Megatron is the baddie in Transformers. So he's reckless, he's arrogant, he's nefarious. He's basically Larry Summers. And his opposite number, of course, is Optimus Prime, which is a very balanced person, which takes the persona of Ben Bernanke.
I had a few Transformers in my day, Marcel, I can assure you.
Didn't we all? Didn't we all?
So, what are your concerns here? What have they said and what are your concerns?
Okay. Our main focus for calendar 2014, and this is really the first step out of the abyss as far as we're concerned. Okay, so 2014 is the beginning of what we can say definitively is the beginnings of a stable US recovery, and of course it is, otherwise they wouldn't have decided to wind back and taper the QE program. So we're on the precipice of a nascent recovery. It is inevitable, therefore, that interest rates in America will rise off the base rate of the zero bound that they've been on for a number of years. And the problem here, what this paper, it's not a paper, it's the US Federal Reserve puts these central tendency forecasts out, and as part of that they assess the opinions of the 17 governors of the various boards of the Federal Reserve across the 17 jurisdictions, and the numbers that these guys have polled is that over half of them, well over 50% of those board governors think that by 2015 interest rates will be 1% higher than where they are. By 2016 they'll be 2% higher than where they are, and the long-term average trend projection that the governors think where the federal funds rate should sit at is north of 4%. So this is very easy to explain. We're currently at zero, so we're talking about 1% 2015, 2% 2016. What that's going to do
too much of an increase too quickly.
Absolutely. And it's not so much the quantum of the increase. I mean, we've had under Volcker in the Reagan era in the early 80s, we've had increases of 2%. But they were going from 11% to 13% in the Federal Reserve rate. Okay, so we're at zero, and financial institutions have adapted, shall we say, to the level of risk that they can take in the marketplace when cash is free, when credit is effectively free. Okay, so the problem here is that it's not a problem. What we need to be very, very aware of is the repercussions of when base rates actually start to move off the zero bound, and they are going to move to 1%, to 2%. And when that happens, that will attract massive capital inflows back into America, because people will be able to have ostensibly AAA rated risk-free credit, which is US 10-year bonds or US Treasury bills, and their yields are going to be magnanimously higher than where they are in present day when they're getting basically nothing. Okay, and this is AAA rated paper. So
absolutely. So something we've got to be very careful of. Marcel, we're out of time, but thank you very much for the excellent advice, and look forward to talking again in 2014.
Thanks, Marty. Take care. Bye-bye.
You too.